Index investing is the best investment strategy for private investors like us because it's easy and accessible, it has a great risk-return profile, and it minimizes your time and effort. And mine. But don't just take my word for it. Listen what Warren Buffett has to say, one of the most famous and greatest investors of our time.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
I'm Sophia. I've learned about money and investing for more than a decade, and this is going to be the first video of a series about investment strategies. Because I want to fast forward your financial journey so that you can build wealth without living frugal faster than I did. Alright, here's what we'll cover. What is index investing, upsides and downsides, and how you can get started. Now before we dive in, just to give you some context, this up to this date is the main investment strategy that I use. So most of my multiple six-figure net worth is invested in index funds. But it wasn't always like this. I remember it was several years ago and I had covered the absolute basics of personal finance and I was finally ready to invest. But at that point, I still thought that I would need to pick single stocks in order to invest into the stock market. But then as I started my research about investment strategies, I came across index investing. I read a book about the topic, it's a German book, there's no translation, but that immediately convinced me. And why it convinced me how this works is instead of trying to find the needle in the haystack, you just buy the whole haystack. And that, by the way, is a quote from John Bogle. I'll come back to this later. And this strategy allowed me to pick index funds once and then keep investing into them without learning complicated stock analysis numbers and without having to constantly look at my investments. And that allowed me to actually enjoy my free time beside my full-time job. And still know in the back of my head that my money keeps growing while I'm chillin'. Alright, so let's dive in. What is index investing? Let me go back to that quote. It's from John Bogle. And John Bogle is the founder of Vanguard. And not just that, he is also basically the inventor of index funds. In 1975, he created the first publicly tradable index fund. It was the Vanguard 500 index fund that tracked the index, the S&P 500, which is a list of the 500 largest companies in America. But this was very new at the time. And his argument was that instead of trying to beat the market, which up until then and even now most investors are trying to achieve, so they have a whole market as benchmark, and then they try to beat that benchmark. But John Bogle said, instead of trying to beat the market, why not just match it? So match the market because it also keeps growing and also at the same time save on high costs and also investment mistakes. He believed that most actively managed funds could not outperform the market consistently. Especially after fees, he would remain right, and that has also been proven. So his philosophy was, don't look for the needle in the haystack, just buy the haystack. And how this works is that you pick an index. An index is basically a list of companies in a certain market. And then you have several different funds that track that index. So you can't really buy the index because it's just a list of companies, but you can buy the fund that tracks the index. Does that make sense? And then by buying the fund, you own a tiny little piece of every company that is represented in that fund. I think that's just genius. And now let's look at the upsides and the downsides. So why index investing works is it is based on the idea that markets grow over time. And that is backed by historical data. For example, the S&P 500 has averaged between 7 and 10% per year in annual returns after inflation. The same goes for the MSCI World. That's an index that tracks the developed countries all over the world. And this one has also grown continuously in the long term. Now, the upsides of index investing is that it is a passive investment strategy. And what that means is that you don't need time to analyze stocks and decide which stocks to pick. You also don't have to think about market timing. So decide on the specific time when you are going to enter into the market and when you're going to sell your investments and get out. Because when we assume that it's just going up long term anyways, then we just put as much money as we can into the market. And that saves us a lot of time. So it's really just a set it and forget it approach, which is one aspect I really love, by the way, because it allows us to grow our wealth while at the same time enjoying and maximizing our free time. The other upside of index investing are low fees. And especially when we compare index funds to actively managed funds, that is a significant difference. And costs for us as private investors are very, very important, because the higher the costs, the lower our return. Because the return in itself may be the same if we have a passively managed fund that costs 0.3% per year, that tracks an index, and then we compare that hypothetically to an actively managed fund that costs 2% per year and tracks the same index, then the return of both of those funds is the same. But because the actively managed one is much more expensive, this reduces the return that we actually get. Are you guys getting this? So I'd say the low costs, one of the main advantages of index investing. And the third upside is diversification. So by buying an index fund, you're automatically diversified. At least you are diversified over a bunch of different companies, because that's the very definition of an index fund. It tracks a list of companies within a certain market. So for example, if you take $1,000 and you buy Apple stocks from that money, then all you have in your portfolio is one company. But when you take the same $1,000 and put it into an index fund, like let's say the S&P 500, then you own 500 different companies from the same amount of money. And what this does is it's spreading the risk. It's spreading the risk over different companies, over different regions, and also over different sectors. That is, if you choose an index fund that is representing a big enough market. Now, I know we do not expect Apple to go bankrupt anytime soon. But still, when you think of your financial future, you do not want to be dependent on the development and on the future of one single company. Now, I chose the S&P 500 as example, but to be honest, I'm not even that big of an advocate for the S&P 500, because it is only one market, right? It's only the US market. Now, it's still a great choice to start with, but as your wealth keeps growing, at least I personally would not stay within just one country. Anyway, and another upside of index investing is that you can start with very little money. And honestly, I think that is so valuable, especially for beginners. It was for me when I started out, because you can take $50, $100, $500 and still buy parts of so many companies of one economy or the world economy. And that's simply not possible if you're starting with a couple of $100 when you want to pick single stocks. All right, in a way, index investing is also, it's protecting you from the emotional side of investing. Because when you have an index investing strategy and you know you're in it for the long term, then you're less tempted to panic sell when the market goes down, which we have seen just recently, or chase trends, new trends that are coming up. So this is a strategy that's sustainable over a long period of time, even a lifetime. Now, one of the downsides of index investing is that it is not a get-rich-quick method. It's rather a get-rich-for-sure over a long period of time method. And just to put this into perspective, the average return that you can expect from index investing, is between 6 and 10% per year. And this is an average. So it might go up 20% in one year, and then it might go down 30% in another year. But then when you look at the average of 10 years, 15 years, 20 years, this is the mark that you'll get. And this may be another downside. So when you look at the time horizon that you need in order to gain from that investment strategy is 10 plus years, if possible even longer than that. And because the market can fluctuate like this, it's also not a safe investment. I hope this is clear. So if you would plan to invest money, but you know you need that money within the next 5 years, then this is definitely not a good strategy, because we simply cannot predict how the market is going to be in 5 years from now. Maybe it's up and you have a capital gain, but maybe it's down and then you do not want to realize that loss. And also, this has never been a downside really for me, but it is kind of boring, because you pick the strategy once and you set up the investment plan, and then it keeps working for you and you don't have to do anything. So if you were looking for more action, then maybe this is a bit disappointing. Or maybe it's deliberating, which it was for me. And there is another downside, and this is also a word of caution from me. ETFs, so exchange traded funds or index funds, have become a huge industry in the past decades. And the result of that is that there are many, many different ETFs or index funds out there, and not all of them are diversified in a way that we would like them to be. So you might find ETFs that are specialized in gaming companies, and it might not even show in the name because the name of index funds can be quite complicated. So it still is important to really look at the products, look what type of companies and sectors and regions they cover, because not all index funds are created equal, if you know what I mean. And now here's how you can start index investing step by step. You start with opening a brokerage account. If available, I would make that a tax-advantaged brokerage account. And there are many where you can do both. So you can use the tax-advantaged accounts, and then you can also have like a normal taxable brokerage account. In the US, examples would be Vanguard, Fidelity, and Charles Schwab. In Europe, it could be, for example, Trading 212. They at least have the tax-advantaged accounts for the UK, as far as I know. Now, internationally, you could go with Interactive Brokers, but they do not offer tax-advantaged accounts, and that's a very complicated interface. So if you're a beginner, that is not what I would recommend. And the next thing you do is you choose an index fund or an ETF. So we already touched on that a little bit. One example that is specific to one country would be the very famous S&P 500. So that's representing the American economy. If you're looking for something broader, like a world index, which is what I'm invested in as well, would be an MSCI World or also a FTSE All World. And of course, you can always mix and match. So that is absolutely no problem. You can go for a world fund and then add a little bit S&P 500 to that, or any other type of industry or economy or market, or the other way around. So you start with the S&P 500, and then as your wealth keeps growing, you diversify further over other markets. And then the third step is to transfer money to that investment account. And ideally, you don't just do that manually once, but you do it continuously on autopilot. And then once your money is in your investment account, you buy the index fund. You can also automate the order. So, for example, in form of an investment plan. And that is already it. And then the next thing you really concentrate on is how you can put as much money into that investment strategy as you can. And a very important first milestone for that is $100,000. And I will link a video for you here where I explain why it's so important. I hope this was helpful. If you're still here, thank you for watching this far. Wishing you success, and I'll see you in the next video. Bye bye.